Folks, we've got a lot to discuss. Number one, a bank crisis metric reaches an all-time high as more banks barrel towards disaster. Number two, a prominent hedge fund manager makes a bold prediction of what the Fed is going to do next. Very important to talk about right now, as the next Fed decision is just a couple days away on Wednesday. And then number three, of course, we've got to discuss the latest big trade ideas in this market condition, including our PXMD play, which has been doing exactly what we've expected, and shorts are just starting to cover. I'll explain what could be next, and I'll put all the timestamps down below. And today's video is sponsored by ZipU and our 50% off coupon code PATTY50, which expires tomorrow night. It is a one-time fee, and you'll gain access to our step-by-step lessons, our private chat, our daily morning briefings, and some other resources that you can learn about with that link down below. Make sure to check it out before tomorrow night. Get your 50% off now. Okay, so I want to go ahead and start with this chart here. Discount window borrowing reaches all-time high. Bank usage of Fed's backstop surpassed 2008 crisis level. So what is the discount window? Well, it's a lending facility meant to help commercial banks manage short-term liquidity needs. As we've been talking about, lots of banks have a ton of their customers' deposits locked in long-term bonds, which if sold now would be at a massive loss. They need to be held to maturity to realize their full value back. So if customers want to go and pull their deposits from these banks, well, the banks don't have the money to give to those customers if it's all locked up in these shitty government bonds. So the Fed goes and offers what they call the discount window to these banks to provide short-term liquidity in this kind of situation. They basically say, hey, look, banks, if you need some money, we're the lender of last resort. Come and give us your toxic assets. We'll give you cash in return, and we'll give it to you at a discount, aka we're not going to pay the full amount of the collateral. In fact, we're going to give you less cash than the total collateral is worth. But at least you'll have cash to pay out the depositors that are going on runs. And in simplified terms, the more banks are pulling up to this discount window, the more you know liquidity is drying up fast as depositors are rushing for the exit. And you could see during the Great Recession, it skyrocketed. During the pandemic, it skyrocketed, and then it climbed at a moderate pace as the Fed tightened in 2022. But then all of a sudden, guess what happened? It skyrocketed. Now, think about this. If you were to go and you were to chart the amount of time the average person spent in the hospital the last 20 years, you'd find the vast majority of the time the average person is not in the hospital. And if you looked at somebody's chart over that 20-year period and you knew nothing about that person, but you saw certain periods of time where they were in the hospital, what conclusion would you draw from those periods of time? If somebody is in the hospital, that means they're pretty damn sick. There's something seriously wrong. And it is the same thing in the banking system. If in 2020 banks went in for a checkup, a casual checkup, well, in 2023, banks are going in and they're in the frickin' ICU. They are getting emergency surgery, and the surgeon is operating with an axe and with his eyes closed. The discount window is essentially a hospital for banks. You know, when a lot of banks are going to that window, that they're very sick. So what has historically allowed banks to back away from the discount window, aka get out of the hospital? Well, monetary medicine, namely the Fed cutting rates and QE. And folks, as you know, we've been warning about this for months. After 2008, the entire financial system was built to be dependent, completely dependent like a junkie on record low interest rates and a Fed that was willing to provide endless amounts of liquidity. But it was never built. It was never built to withstand high rates, and it certainly was not able to withstand this pace of tightening, right? This pace of raising rates, this pace of QT. And so now by trying to crank down on inflation, the Fed has essentially broken the entire system, and it is only going to get substantially worse unless the Fed pivots. The good news, though, is that if the Fed continues to go through with more rate hikes and more tightening, well, inflation will almost certainly drop substantially because everyone's deposits are going to be gone. Remember, the fractional reserve banking system essentially expands the money supply exponentially until it blows up in everyone's faces and contracts as money evaporates. If I give $1 to a bank and the bank lends it out to another Charlie, who then goes and puts it in his own bank, who then goes and lends it out to another Charlie, well, you've just expanded that $1 to having the impact of being like $3 or $4 in the overall system. Back in October, when we spoke about why banks will need to freeze withdrawals in the coming liquidity crisis, we broke down an example of how if $100,000 gets lent out just a few times and each bank keeps a healthy reserve, it can still very quickly turn into about $271,000 in the system after just a few iterations. And that's a very conservative estimate with a very high reserve standard, which most banks don't follow. And again, small banks don't have to follow the same reserve standard that big banks do. We have this weird situation where we decided to encourage tons and tons of small banks to pop up because we decided not to regulate them the same way as we regulate the big banks. But the thing is, when you put them all together, as we're seeing now, when you add up all the small banks, well, it turns out that they're kind of a Goliath. The reality is that in a fractional reserve banking system, a dollar goes through an unlimited amounts of periods of being lent out, and all of a sudden, when it gets stopped, the house of cards collapses and Papa Fed has to come in and re-stimulate. The monetary system is a massive house of cards that continuously expands until one of the cards starts falling. If you want to learn more about how the fractional reserve banking system works, I'll go ahead and link to this video down below. I highly recommend checking it out. But nonetheless, it is obvious that right now we are in the beginning of what is going to be a massive crisis. And actions taken right now by the Fed and by US regulators and by the biggest banks are going to have a big impact on the outcome. This is the most crucial time to watch the response because the response is going to have the biggest impact right now. Responses in a year or 2 years to this probably not going to have nearly as much of an impact because the damage is already going to have been done. Anybody that tells you that things are just berries and roses and then it's all FUD, will just have them open their eyes to what's going on. The KBC letter tweeted this morning, markets in 2023, bank stocks halted 10 plus times per day. Swiss government covering losses for UBS Credit Suisse. FDIC backstopping deposits on collapsed SVB. Fed provide liquidity after years of QE. Regulators delisting, auctioning banks. This is far from normal. And that is exactly right, folks. Anybody that tells you that fears are overblown clearly has their eyes completely closed. These individuals clearly aren't looking at the fact that banks themselves are running to the proverbial hospital at record paces. And remember, folks, banks, they do not want to go to this discount window. It is horrible to go to this discount window. It makes them look weak. It makes them look like pathetic little banks that can't handle themselves without going to Papa Powell. Daddy Powell, please give me some of those bucks. When banks go to this window, it makes them look terrible to the people that are invested in them. It makes them look terrible to their depositors. It tells the world that, hey, we have a liquidity crisis. We can't manage our liquidity. Don't bank with us because we don't even know how to manage ourselves. And they also get a bad rate. They get a discounted rate on their collateral. So they only go to the Fed. They only go to this hospital in a last resort. The lender of last resort is the Fed. So when you see them all rushing here at once, what does that mean? It means that we are in a dire situation. Now let's talk about what a prominent fund manager is predicting is going to happen and what he's personally doing with his money. Business Insider reports the US is going through a textbook financial crisis, and that means investors should expect sluggish returns in the S&P 500 for a long time, according to billionaire investor Leon Cooperman. But Charlie, wait a second. Why are we in a financial crisis? Janet Yellen says everything is fine and dandy. She wouldn't be yelling up a storm of positivity if she wasn't right? Well, I mean, any environment where regulators are orchestrating $30 billion rescue plans with bigger banks trying to rescue smaller ones, well, any environment like that is a shaky environment at best. Kind of like textbook. Cooperman said, we have a self-induced crisis by irresponsible fiscal and monetary policy over the last decade. I did not forecast the SVB issue, but I did have a view that we were heading into a crisis of some kind, and we're seeing it. Cooperman expects that the Federal Reserve will likely hike interest rates by 25 basis points on Wednesday, and that it will then be ready to accept a higher level of inflation for the sake of stabilizing the financial system. He said the latest crisis is the response to debt buildup in the country and questioned how many out there want to buy U.S. debt, which is estimated at more than $31 trillion. The banks are not buyers anymore, he said. So he's saying Papa Powell is going to accept a much higher rate of inflation. And I've read other opinions from folks that are saying, hey, you know what? The Fed is just going to simply extend their time frame to reach that 2% target. Oh, we said 2 years to reach 2%. Oh, we meant 20. That way they could say, no, we're not backing down on our target rate of inflation. We're just extending it out. We're going to take our damn sweet time, maybe even cut in the process. But don't worry, the cut will be transitory. Pansatory. Now again, though, if Powell decides to stick to his guns and keep raising rates, inflation will indeed no longer be a problem real soon because there's not going to be any cash left. There's not going to be any banks left. JP Morgan Chase will own the entire banking system and Jamie Dimon will be the pseudo Federal Reserve chair. And honestly, I think he'd probably do a much better job than Powell. But anyways, Cooperman is making the argument here that Powell is going to really quickly switch dovish and turn the money printers back on. And that is going to result in this market environment where you have really high inflation, elevated inflation, and then rates going back down. Which means, guess what? Eroded earnings power, but still pricey equities. Pricey equities that pretty much stagnate over the next 10 years until earnings can really catch up. In Cooperman's opinion, investors are now in a stock picker's environment, especially if the S&P 500 turns out to be very pedestrian. He believes that we've seen the fat years and that now we're headed for 7 lean years, adding that the S&P 500's all-time high near 4,800 is probably going to remain the top for quite a while. Okay, let's go ahead and talk trade ideas. And as always, because you're the one that's going to be taking the risk, make sure that you're the one that's going to be doing the frisk, right? A lot of people get real frisky, but they don't think about their risky. Let's start with PXMD, the lovely Pax Medica. So PXMD, we made a video breakdown for on Thursday when it was trading at about $223 a share. We had already briefed on it several days prior at decently lower levels, but in that video, I presented the case for why it might be a worthy buy at $223 a share. We went into the short setup, the float, the catalyst, and so on and so forth. I said I see its retention period ending in yet another run and breakout, and then that ending in yet another retention period. In this case, that's exactly what happened, and it broke out to 307 on Friday morning, and then had its take profit cycle today, which then it proceeded to bounce off of quite a bit. Now, as expected and is commonplace, shorts used today's lovely dip to close out of their short positions, buying back shares. Oh, not so tough now, huh? Not so tough. I guess it went up a little bit. That was too much for you. Now you got to get out as fast as possible at just a little dip. Now, why would shorts that shorted mostly at lower levels be willing to cover at a loss this high up? Why would they be willing to buy back shares this much higher up? Well, likely because they are worried about the risk of this skyrocketing much further. And if shorts continue to rush for the exits by, again, buying shares, because that's how covering shorts works, and the overall momentum stays strong and it keeps piquing people's interest and momentum traders' interests as it breaks out to newer and higher highs, well, I expect PXMD to have one of the best breakouts this week. One of the most insane resistance break and shatter and breakouts. Again, that is just my process of thinking here, because you're seeing the momentum build and build and build, and now you're seeing shorts start covering. That is a killer setup. But anyways, don't take my word for it. You want to see some proof of concept. The next critical breaking point is 307. Watch for that and place this atop your radar. Watch the volume and watch how fast it can hold those take profit periods, because you get one that doesn't hold and boom, you've lost confidence in the stock, and then all of a sudden you get a massive sell-off. At the end of the day, we know how these trade. They go up and then they go down. So you want to be very careful that you get it during the up cycle, during the momentum cycle, during the proof of concept cycle, and then you lock in your profits, or in some cases, yes, your losses very early on. Next, LYLT. So this is part case study and part potential new upside opportunity play. So we briefed on LYLT at about 13 cents a share this morning after it showed extensive pre-market activity that then dumped before open. This is a pattern you'll often see before huge breakouts, a pre-market ripe with moves and people trying to chase the low extended liquidity, the low extended hours liquidity, and that then puts it on the rest of the market's radar come open. It triggers a lot of those scanners. And likewise, it ran to 29 cents right after open. So that is a more than double from the briefing price. Briefing price, the highs, more than a double here. And in this case, that's simply because we knew that pattern, right? We knew the situation where all of a sudden, if you get a lot of pre-market activity, you get a lot of pumpy dumpy in the pre-market, well, that's going to catch a lot of people's attention. And if you get just a little bit of proof of concept come open, all of a sudden the rest of the market starts pouring in. And in this case, that worked out pretty well. And that is the power of doing pre-market research. Now, the goal of the briefings, of course, is to find tradable opportunities. The performance of our briefing ideas tends to vary greatly based on market condition on any given day and whether there's even a lot of runners present in the market. You know, we have situations where you go through weeks where you have no runners in the market, and it's like, well, it doesn't really matter what you're looking for. If there's no runners, there's no runners. And other periods where there's tons of runners, right? So a lot of the situation when it comes down to how much a catalyst will run is based on the market condition on that given day. But in any case, today, very fun with this play. Anyways, if you'd like to be a part of our daily morning briefings and the full ZipTrader review program, again, we have our Patty50 coupon code, which will be expiring tomorrow night. But anywho, moving forward, the critical breakouts that we want to watch for are at 29 cents and then at 37 cents. If it can't break out again in the next 2 or 3 days, it's more likely than not dead. Shout out to folks who played this correctly, but you don't want to overstay your welcome if it doesn't continue showing proof of concept. That is for literally any stock that we've ever talked about. And it's also good relationship advice. If you get into a relationship with someone that you really like, and then all of a sudden, well, the relationship is toxic and bad, you want to get out. It's the same thing. It's the same thing with stocks. It could look like a really good setup when you get in. It could run a decent amount, but all of a sudden, if the setup's not looking so hot, well, maybe you should get out. And lastly, by the way, make sure that you always pay attention very closely when we have sponsored stocks. We had a sponsored stock yesterday, and it did pretty exciting moves today. We only accept the most exciting stocks for our sponsored segments, and yesterday we presented the setup on INM and why I saw short-term and long-term potential, and it completely destroyed the game today, breaking out to 168, up 47% plus at highs. We've got another sponsor sponsored stock coming later this week on Wednesday, and there's some really strong upside potential, both long-term and short-term, that I see. I could be wrong, but again, I really would pay attention to these sponsored stocks because a lot of times they have some really interesting setups, and we only take the best stocks that we like in our sponsored stock segment because we do get a lot of offers. Anyways, that caps off today's video. Make sure to hit that ravishing like button and subscribe. Check out that link to ZipTrader U down below. Patty50 will get you 50% off. Expires tomorrow night. Make sure to get your 15, or is it 17? Yeah, 17 free stocks now with Moomoo with the link down below as well. Excellent broker. If you're broker curious, you want a powerful platform, well, make sure to check that one out. Have a good one, folks, and we'll see you in the next video.